Welcome, everyone. With the rise of inflation, interest rates, and talks of a recession, it is quite obvious we're going through a tumultuous time in the economy. But you probably don't know that debt providers look at things a bit differently. To help understand the market from a debt perspective, I'm excited to introduce Brandon Baksh. I first met Brandon at our most recent conference at NMHC in Vegas and was quite impressed with his financial acumen, and I knew I had to have him on the show. Brandon graduated from the Macaulay Honors at Baruch College with a major in finance and a minors in political science, business law, and New York City studies. I didn't even know that was a major or minor, but he has minored in New York City studies. Brandon began his professional career at Dwight Capital, a commercial real estate finance company, as its seventh employee. Today, nearly a decade later, Brandon has closed over $2.5 billion in FHA financing at Dwight Capital, which has become one of the largest and fastest growing direct lenders with more than 100 employees. Brandon has closed loans in over 30 states with a concentration in the Mountain West, Mid-Atlantic, and Sun Belt regions. Aside from work, Brandon enjoys spending time with his family, playing basketball, and snowboarding. Welcome, Brandon.
Appreciate it. Thank you for having me.
Absolutely. Happy to have you. First question, New York studies. Can you tell us a little bit about that? Because that sounds interesting.
So the program that I was enrolled in, Macaulay Honors, it's a requirement. So it was created by William E. Macaulay, a hedge fund guy based out of New York, and he wanted to give back to the city. So he created Macaulay Honors as essentially a joint venture between his program to give an accelerated course of learning with CUNY system. CUNY is a city university of New York. So as part of giving us full ride, full tuition, he wanted us to be able to learn about the city where we're staying and then be able to give back to it. So the minor consisted of 4 classes spread out over 2 years that focused on arts and culture, immigration, the sciences of New York, and the ecosystem and things of that nature. So it was not something I was familiar with when I was going in, and I still get asked questions about it today.
Well, that's great. Well, thanks for sharing that. Okay, let's go ahead and get started with just a simple question. Looking at the 30,000 foot level, give us a brief 1 to 2 minute overview of the markets as you see it today. Specifically, talk about inflation, the market indices that you follow, what they're telling you, and where you see the market headed.
Sure. So you look at it from 2 different perspectives. The folks that really tried to take advantage of interest rates when they were super low during the pandemic days, the 10-year Treasury, the lowest intraday low was at 34 basis points, I believe. And SOFR was at 3 basis points. So folks use it as an opportunity to go out, acquire projects using cheap capital and really to grow their business. Folks, in doing so, started upping it compressed cap rates because capital was so easy to access that it created so many new players into the space, and it really pushed down cap rates to lows that we have never seen. You're talking about places that in Phoenix, things are trading at 3 caps, and I thought that was reserved for the New York and LAs of the world. And because of that fallout, you're seeing the cycle turn on them. And so a lot of the issues that are stemming from there is that people are getting over their skis. I mentioned snowboarding, so I'll use that analogy. The market right now is in 2 sectors. Those people who are in panic mode, and then the people who saw the cap rates compressing and then sat on the sidelines saying, hey, let's grab a box of popcorn and watch and see what happens. So that dichotomy is really coming to a head right now. We're seeing it, folks who really, really got aggressive and are struggling a little bit. But then you have the folks that sat on silent, and then you have your very sophisticated investors who pick their spots, weren't aggressive, and they found things that fit their value, good economic drivers, weren't just going to COVID cities or more blips, and focus on the long-term fundamentals of projects. So at a 30,000 foot level, it depends on where you look, because You're going to see some people sitting very calmly on the sidelines and waiting for it all to pop, and other people running around Chicken Little style, waiting for the sky to fall.
Now, do you think this is going to continue for some time? The pressure on the markets, do you find it's going to ease up a bit, or what are your all telling you?
I would strongly believe that's going to continue at least for the next 2 quarters, next 6 months, roughly, due to the fact of where the Fed is right now. So we saw last week or 2 weeks ago where the CPI and unemployment is still incredibly low. CPI is still rising, inflation is still rising, and it's showing the Fed that making the Fed at least believe that they haven't done enough. So we had seen the first drop off in rates, the incremental Fed funds increase to 0.25 point So now are they going to up it to 50 basis points next one, keep it longer at 25, incrementally going longer there? If you had looked at the yield curve, a lot of experts were believing that we would see rate cuts towards the end of this year. And that timeline's probably pushed out anywhere from 4 to 6 months where we might see cuts again. And it looks as though the Fed is actively trying to force a recession, to stave off inflation.
You're guesstimating that we will start seeing rate cuts starting next year.
End of this year, Q1 next year, my guess.
Okay, great. Well, I appreciate that overview. That helps us frame things. Let's talk about the multifamily markets. Give us your take on that.
Right now, there's not much activity. So a lot of things that investors are owners are worried about right now are what happens if they go to sell, because there's going to be an onslaught of supply coming online, and then cap rates are going to get pushed upwards. And so no one wants to be the first one to dip their toes into markets. So you're seeing a lot of off-market transactions, going back to repeat buyers saying, hey, we can do that, we can transact at this level, things of that nature. Right now, for example, internally, we're seeing our pipeline is folks that have developed and need to take out financing for that construction loan, or folks that used short-term bridge financing and need to get out of that. No one wants to sell right now. We're seeing the biggest exposure that we're seeing on that front is interest rate caps. Some people use them, some people didn't. And the folks that didn't, there's a lot of panic run. Those are the Chicken Little folks, where if SOFR has gone from 3 basis points to over 4.5, and they are trying to absorb that 4%, that rent growth isn't there. The premiums that they were hoping on value add isn't there. So they are trying to pull the parachute early and go into a fixed rate financing to buy themselves more time now.
That makes sense. And for our listeners, what he's talking about in terms of rate caps are specifically looking at variable rate debt. And with variable rate debt, as Brandon mentioned, it follows a certain indices or index, and SOFR is that index. So as SOFR rises, then the interest rate of that particular asset rises. And if you have no cap on there, cap is basically insurance. So if you do not have a rate cap on that particular type of that asset, that loan, then your rate's going to continue to rise. If you have a rate cap on there, that insurance company will in fact pay down some of that mortgage payment for you, so that you're not going to have escalated amount due over time. And that in fact has saved, I would say 95% of people that are in that market have gotten rate caps. It's only a small percentage that have not, correct?
So the advent of the bridge market. So those are the people, I mentioned that Chicken Little, the real true people are the folks that started doing the bridge debt in 2019 and 2020. Rate caps so far were so low. If you looked at the yield curve back then, no one expected this kind of Fed aggressiveness in terms of raising rates. So generally folks who did bridge debt, floating rate debt in 2019, 2020 are the ones without. And afterwards, that's when the Fed started getting more aggressive. And so those are the ones where rate caps were required to close.
Got it. Okay. Well, appreciate that overview. Now let's just dive into more specifics about what you do. Can you tell us how debt providers such as yourself evaluate assets differently from equity investors?
Sure. So we're solving for a long-term look on the project. So we didn't talk about this, but we as Dwight Capital has 2 different pockets of lending. So we have our private REIT where we do bridge on our own balance sheet, and then we have our HUD lending finance on. On the bridge side, we look at it as more of an ability to repay. We stress test everything in a significant way so that if things go awry, there's a workable plan and we're not panicking. So that is number one, the ability to repay, and then what the takeout financing looks like. On HUD debt, it's a lot simpler. So HUD is a very self-sufficient product in terms of what your exit is going to be. You have a lot of flexibility. It's 35 years, fully amortizing fixed rate. So you don't have to worry about impending maturity risk. You don't have to be worried about being forced to sell or anything of that nature. More so, HUD has something called the interest rate reduction program that will allow you to modify your rate at any point during the loan in case rates fall. So you can always take advantage if there's a downturn right after you've done your loan. So that's something that helps. So on the 223F, the HUD side, which is most notable for its 223F refinance program, we're simply solving for trailing cash flow. And we apply a vacancy factor of 7%. And as long as it meets we're constrained by 1.176 debt service coverage ratio or 80% of value. And so it's very simple on that front. The bridge side is infinitely more complicated because you're dealing with value add in certain situations. So you're trying to pro forma out numbers. You're looking at comps. What can the market attain? So you're looking at what the economic drivers are for that specific market. Is there a school? Is there a hospital? Things of that nature. And that'll all impact our ability to lend and how high the capital stack we can go.
You're talking about the products that you have and how you're looking to evaluate a particular asset. And just to break it down to those investors that didn't understand all the details that went into it, basically what you're saying is you're offering two packages. The first is, describe it in just layman's terms, Brandon, so we can understand the first one, and then you can talk about the HUD.
Yeah, so it's Dwight Mortgage Trust. It's just balance sheet bridge lending. So short-term financing to facilitate acquisitions, things of that nature.
Okay. And then the HUD program is just in a kind of a soundbite.
It's permanent fixed rate financing.
And the way you guys evaluate these types of assets is more conservative than an equity investor, for example. You're looking at the borrower's ability to pay the loan. You're looking at the cash flow of the property and the borrower's financial history and creditworthiness. You're looking at the collateral that secures the loan. You're very conservative in your approach. So this is much different than an equity investor who is willing to take a bit more risks, more of a risk rather. Can you just elaborate on that a little bit further?
Yeah, so to your point, all of our loans are non-recourse, and that has generally been the case for Bridge. So while we're not as fixated as the sponsor's trustworthiness, the creditworthiness of the sponsor, it is something we want to be with a experienced sponsor that knows what they're doing and that is capable in case things go sideways, that they have the experience and the wherewithal to pivot as needed. And so that's something that's a big, big point for us. A lot of times we get sent proposed transactions with first-time developers or sponsors who don't know what they're doing. They were in a different asset class or decided, hey, I want to try my hand at real estate. And so that is not something that we are particularly fond of in terms of lending. Then going to the asset side, it's trickier just because of a lot of the situation. During the last 2-3 years, everything has been value add. And so more than the asset itself, we're looking at what are those rents achievable? What are the comps in the market? How likely is it? What scope of the renovation? What can they absorb any cost increases? How long will it take for these units to absorb into the market at the higher rent levels? Is there demand for it? So those are things, to your point, it's more conservative. We definitely look at it at a more conservative point of view. And it's covering in case of I guess the biggest way to describe it is debt is we assume the world is falling, and the equity side are assuming the world's going to be in a more positive light.
Now, if we have investors that have the same sentiment as you guys, feel like the world is falling, can they invest in debt?
They can. So a lot of groups like ourselves, actually, we are structured as a private REIT. And so we do have investors in our REIT. For example, I'm an investor in Dwight Mortgage Trust. And so, yes, you can invest in debt as debt.
Okay. So through a REIT structure, basically.
Yeah, exactly.
Okay. Right. And again, that's a more conservative approach to those who really don't want to take much risk, those who are looking to take a little bit more risk, but also believe strongly about the fundamentals of the property. They like the supply and demand dynamics, overall market trends in a particular area. They like the operators and the sponsors that work in that particular market. They're willing to accept a higher level of risk, knowing that they're putting their investment at more of a risk, but then potentially there's a lot more gain. Do you want to elaborate on that further?
Yeah. So I give you the counterpoint. I am invested in Dwight Mortgage Trust, but I am also, we have a different group internally that does sponsor side. And so it's the same thing. It's much more aggressive. It's definitely much more risk. But if you underwrite things in a certain manner, if you take the blend of the two personalities of sky is falling and sky is perfect, you can come away with some really good transactions that are risk adjusted, great returns, and really great returns. So you can do it. It's just, we're starting to see the cracks in the markets now for equity investors who just invested blindly and did it with sponsors who didn't have as much of a track record. And that has been the issue. But if you find yourself, there's one gentleman we invest with, and they underwrite it, and it's realistic, and it's not penciling to a sale. It's looking at, and he has 10 different ways if things go sideways. As long as you're with a good sponsor, that risk-adjusted return will be well worth it.
Are there ways that an investor can look at a particular deal and say, hey, look, this investor has received debt quotes and is going to acquire debt from this particular servicer. We know that this is a good deal versus another one. Is there a way that investors could determine that?
I don't think there's a carte blanche way to do that. I think in general, you're looking at what the terms are for that debt. You have to look at it case by case. What the biggest way, I think one of the biggest selling points for us as Dwight Trust, and this will answer your question in a sort of roundabout way, we are a balance sheet lender. So which means we are directly invested in the deal's success as we are as this almost as much as the sponsor. We don't want anything to go sideways. So we're going to be more cooperative, more willing to work with sponsors to make sure there's a successful end for everyone. What threw a lot of people in is throwing a lot of people in trouble is the debt they've done it with larger shops that securitize and they sell it off. So they are not on the hook. They don't care if the project goes sideways. They've got to pay their origination fee, and that's it. They're done. Their hands are wiped clean. And so that's the one way for an investor to know is another check, right? Checks and balances, another check and showing that this has been underwritten in a way that is sustainable, achievable. Or is this just more of a, hey, they're just a turn and burn kind of shop? So that in a roundabout way, yes, looking at the type of product you're doing.
Interesting. So if someone sees that a sponsor has acquired balance sheet debt on a particular deal, then that's just another data point demonstrating that the property has been scrutinized to a greater degree than someone putting agency debt on a particular property.
Exactly. And even agency debt, I was speaking more for the bridge CLO, so the collateralized loan obligation, what I keep referring to on that floating rate debt. Fannie and agency, there is some risk for the lender. So you see Fannie and Freddie are starting to pull back because of that, where the markets are going. The CLO shops they're more or less shut down, but now because of no one wants to buy those securities on the back end, but that took a long while to come to fruition.
Okay, so there is risk for the lender on a Fannie Freddie type structure, but not the CLO at all, right. Not the CLO level at all. Okay,
outside of reputational risk.
All right, let's move on to underwriting multifamily real estate. How's that process changed over the past year in terms of the debt structure? And what factors do you consider most important when evaluating potential loans and operators?
The time horizon is by and far the number one because it impacts so many different things. If you just take that and look at the forward yield curve, because when we do our bridge loans, we stress test the interest rates. We're looking at where inflation is, where rent growth is in that specific market, what the projection is. You can go to any of the major appraiser shops and they'll give you their forward outlook for a given market, and something we do quite often. We also have access to CoStar, Yardi, Axio, things of those nature. So it gives us a good idea of where that market is heading. You see vacancy start ticking up. It's not something that you want to be extremely aggressive on because, there's probably a lot of supply or softening in the market for one of many reasons. The biggest thing that we do on all of our deals, and this is something that our bridge lending arm is taken from our HUD lending arm, is HUD requires a 7% vacancy factor. So it's a good buffer there because you're never going to operate a project with intentional 7% vacancy. So it's a good buffer there and making sure that your underwriting is not pushed past a break point. So when we're underwriting transactions now, that time horizon is by and far the most important thing. How quickly can you turn units? What is the supply chain? Because that's something that during COVID was impacting a ton of our deals on the construction side and then value add side. How quickly can you get supplies in to complete your value add program? So that time horizon is by and far the number one in terms of the deal.
And then what about the interest rates? How do you take those into account given that there's some uncertainty here?
So we stress test everything. By default, we are required to, especially on our bridge lending arm, to stress test everything. Depending again on that time horizon, depends how far we're stress testing it. We look at the forward yield curve, see where SOFR is going, see what we've seen out of everything. What we do as backstop for everything, we underwrite a HUD takeout. And the reason being is that it's the most aggressive permanent financing out there. So we back into that. So we stress test the 10-year treasury and see what the 10-year treasury forward yield curve looks like. So on interest rate side, we require as you explained earlier, the interest rate cap. That is a requirement on all of our transactions these days. And Those are a pain in the butt to deal with, but they are, as many people have learned, a saving grace.
You're stress testing it multiple ways, making sure the deal does not default interest rates, looking at vacancy factors, looking at supply chain issues, like all of the above. And if everything passes that muster, then you go on to quote debt for that particular deal.
Correct. And then, another thing that I wanted to mention, well, big variable in terms of looking at transactions today is insurance and taxes. Depending on what state you're in, the tax number on a reassessment is punitive almost. And same thing with insurance. The state I have in mind while saying that is Florida, just because everything we've seen in hurricanes and property taxes assessment there, it has been really, really aggressive. And that shifts underwriting in such a dramatic way. So that's two other items you'll be looking at.
Absolutely. Absolutely. Those are important. And in fact, there have been many deals that we've looked at when we've accounted and adjusted for taxes. They just didn't pan out. I mean, that tax is a huge factor in underwriting these deals. And if you do look at a particular deal and a sponsor and you look at the current taxes and the sponsor doesn't change those over time or only increases them a small amount over time, you should definitely ask them about that. Ask them where they're getting their tax information from, how this is calculated, because that can break a deal without question. Also, insurance, same philosophy. Insurance rates have been going up tremendously over the past couple of years, and we anticipate them to continue to rise. So if you're seeing flat interest rates at a deal, check with that sponsor, make sure that their underwriting is correct. Excellent. Okay, and let me ask you this question: what is your approach to managing risk in the debt market, and what kind of strategies do you employ?
So with the HUD financing, risk is not as much of a concern just because the product itself is risk adverse. So I'll answer this in the scope of our bridge lending arm. It's our credit committee is by far, we see so many transactions and as I mentioned to you, my team's concentrated in certain geographic markets specifically. So if we're looking at one deal in the market, the odds are we've seen 2, 3, 4, 5 deals in that same market. So we have a good idea of how things are operating, what the trends have been. We have their trailing 12-month financials and probably even more likely a 2-3 year history. So from a risk perspective, we're able to essentially accumulate all those data points and extrapolate it forward to the products. What are the competitive advantages on location, things of that nature. But our credit committee internally is going to be the biggest risk adjuster. The two principals of Dwight Capital, Adam and Josh Asunas, have been very good at being aggressive while making sure that we're not being overly aggressive. Sometimes there are just transactions where we're saying, hey, we're just not going to be able to get there. And so it's knowing when to pull.
You get a separate risk committee that evaluates the deal after it goes through the first pass. You evaluate risk in the credit committee, and if it passes there, then you're good to go moving forward.
Yeah, that's one of the things our clients love. To amend the one statement you made, one of the things our clients love and hate about us, we actually do credit committee early. So that first pass, it's credit committee approved when we issue that term sheet. And our clients hate us because it takes an extra 2-3 days to do that, but then they know they're not going to get retraded.
Yes. Yeah, that's great. Where do you see the biggest challenges for multifamily real estate investors in the current market in the next few years?
Interest rate costs and costs for hard supplies. Those are the two biggest things. A lot of our clients are trying to do ground up development or to buy projects. And then interest rate costs, it's also the mindset that has to adjust. Everyone is still stuck in the idea that we're in a 4 cap market, a 4.5 cap market because there have been no sales. The reason why there have been no sales because everyone who wants to sell knows what's out there. That when they be the first to market, they're going to see a significant dip in what they were expecting. And so the mindset and understanding what the project is, the phrase, you're only worth as someone else is willing to pay for it. And so that's a big thing that sellers in this market are going to have to adjust to.
And have you seen some of that adjustment on your end?
No, that's the stubborn part. We get saved from a debt perspective of having saved myself from giving that hard news because we're not value constrained these days. Everything we look at is DSCR constraint, debt service constraint. And so I don't have to tell them your project is worthless.
Can you describe what that means, the DSCR ratio, what that means?
Yeah, so it's essentially your NOI divided by your debt service payments. And so our requirement is a 1.18 ratio. on the HUD side, and we back into that on the bridge lending. And so the other limitation for HUD is 80%. We're nowhere near that these days, just because everything where interest rates are. So I'm spared from having to tell someone, hey, your project is not worth the 50 million it once was. It's more worth than 40 because my debt number won't change because we're income driven. At some point, when these folks' loans, they're longer term loans, because a lot of sponsors took advantage of low rates and matured a lot of their portfolio, refinanced a lot of their portfolio when rates were low. Now you're going to see the new wave, the 2020, end of 2023, 24, and 25 maturities come, and you're going to see that pain. Really, you're going to see it on their faces. And that mindset change is going to be the most difficult part. It's always the most difficult part.
And I can absolutely see that happening, especially to those folks who have not received or purchased interest rate caps, those who have the term of their loan that's going to expire in the next several months to a year or so. They're going to really be hit hard, and they have to decide whether they want to potentially do a cash-in refi, but maybe sell at a much lower number that they were hoping for. I mean, there are options out there, but these aren't the best options for some of these sponsors.
To that point, so the newest arm Dwight Mortgage Trust is actually a rescue capital group that'll provide preferred pieces or mezzanine debt to plug that gap. So sponsors. So we're in that gray phase, right? You're going to see the part is shifting over and over. Can I save my deal? Can I just keep the deal as is? And a lot of people who acted a year ago or 6 months ago were able to do that. Refinance, be cash neutral, bring no money. They were upset they didn't get a cash out, but they didn't have to write the check. Now it's that new phase of, hey, I have to write a medium-sized check depending on the deal, and can they stomach that, or do they have to go make a capital call? So as these rates maintain at these higher levels, you're going to start seeing folks having come to the fact that either I write a large check or I go get preferred equity, or I get a mezzanine loan that'll plug that gap. And so that is slowly what we're entering, and we anticipate that. So that's why we launched the Rescue Fund.
Now, how specifically regarding this Rescue Fund, how does that make sense for you guys? Where do you see opportunity in that?
So the big thing is how long these high interest rate environments will last, right? So as I mentioned too, everything is debt service constrained right now. It's not really about value. So where you're looking for a point of the products that we're investing in right now as a preferred equity piece or mezz debt are projects that are good assets. It's just that NOI growth isn't there as fast as they would like, or it's just interest rates. Say it's a well-positioned project, good fundamentals all around. And if rates weren't at the 5-year all-time high, this project would be doing really well. And so that's how we're identifying it, that the value is intrinsically still there, and that the project it's just about more surviving this rough patch. And then on the other side, you'll be in a great spot.
Okay. And there's opportunity for you guys because it sounds like there are not many providers offering this option. Is that correct?
You're starting to see it. There's just different situations. As I mentioned, I didn't mention this, but one of the things to understand our mindset when we approach these deals, we're not a loan to own shop. Well, on our bridge side, we do not want to foreclose. You have some groups that are there, do that, like on the securitized market side, you're going to start seeing notes sell to some larger shops that are known for foreclosing, taking over, and then short selling, things of that nature. We do not want that. So that's the biggest advantage for us. I think because when we're doing these transactions, you have to have trust between us and the sponsor. We're in our loan docs, you see everything there, everything for the vast majority of it is negotiable. The benefit of not being securitizing our loans, we get to be more flexible. So this is a short-term investment for us. We want you to get out of it. We do not want to own your project.
Switching gears to sponsors, to investors, where do you see the biggest opportunities facing the multifamily market now in the next few years? So we're focusing on opportunities again.
Yeah, so it's the other side of that same coin that we talked about. Those folks who have maturing debt, who don't have rate caps, those are the ones that will have no choice. So I mentioned that pref equity piece. Sometimes, I don't know many projects, I'm not sure if you either, but who can absorb a 4% increase in their interest rate and then keep chugging along and not have any significant equity required to close that debt, potential refinance. So the opportunities are right there. I mentioned to you, we have one group of clients that essentially sat on the sidelines. They are all, they're liquid and waiting, more or less. So that is folks who did not overextend during this period are the folks who are going to be well positioned to get in at a good value.
Excellent. Yeah. So there are absolutely opportunities
Very much.
out there. Maybe not as much now, but certainly as we move forward the next several months, several quarters, we're going to start seeing more and more come out.
Definitely. And, personally, where I see a lot of the value are these new construction projects. Replacement costs, getting general contractors, wage growth, all those things are like big metric I look at is replacement cost. What does it take? If I bought this project at X, what does it take to rebuild it? And a lot of our clients view it the same way. So can I buy this project at below replacement cost? And that's a huge thing. And I think over the next 6 to 12 months, you're going to start seeing a lot of those opportunities.
I see. So new construction, lease up opportunities where they have budgeted way too much, replacement cost is much less, and they're just looking to unload.
Yeah. Unfortunately for those folks, with COVID, the supply chains got extremely interrupted. We still have clients that are dealing with looking for switch boxes on new construction, and because of that, they're not getting their certificate of occupancies, and therefore they can't get people into the projects. So if they are eating into any reserves that they had, and eventually they will need to sell or refinance with the cash in. And so those that are forced to sell, those are going to be, in my mind, the best opportunities, because you're getting a brand new project, the pain in the butt to go through all that again to rebuild it, very likely to get it at replacement cost or below. And I think that's the biggest opportunity in my mind.
Now, what about switching gears to technology like fintech? How do you see that impacting multifamily debt markets? Are there any softwares that you find particularly useful?
Yeah, so the biggest thing from our perspective is CoStar and Axio and Yardi in terms of data points, right? You want to try to understand, as someone who's based in New York and doesn't get to see and travel every single day, or doesn't get to spend days in a specific market to understand exactly what's going on there, what's happening. I get to look at a lot of data points through those programs. Additionally, in terms of understanding and from your perspective, what debt options are out there, you're seeing an automation of the mortgage banking process widely and a wide scale that makes it simple to get multiple debt quotes at the touch of your fingers. I don't think ultimately it'll substitute more human interaction, because there are some nuances that the programs won't understand, but I think that is a good tool to educate sponsors on what's out there. I think by and far that's been, again, looking from my lens, which is a HUD lens, we work with a few mortgage brokers that heavily employ technology. And while everyone sees the 35 years, 40 amortized fixed rate, all that stuff is great things, HUD, they're still explaining the nuances. So I think fintech has been working as a great complement. And I think over time, we're going to see a lot of fintech taking over, like something I would do on more of the minutiae I do on a day-to-day basis to underwriting process. For example, we're actively trying to develop programs that'll automatically underwrite projects, and we'll have it reviewed by a human, but it'll lay the numbers for us, and it'll speed up everything.
Is there a particular technology that you would recommend for an investor, for example, who is looking to invest in a particular asset and he wants to plug in some numbers and see if it makes sense? Anything like that?
Not off the top of my head. The best technology I think of is reaching out to someone that a mortgage lender you have a good relationship with. So this is something that we do. And unfortunately, it's not going to be a great answer to your question, but we've developed models that are sponsor friendly. It's not as annoying and complex and looking at it from a debt perspective, but it looks at it from an equity perspective. And it's inputting the numbers. You can drag and drop, mostly copy paste. Nothing is clean yet. It's something that my team overall at Dwight that we've created. That hard part, we actually took a stab at trying to create a fully automated, and just the different formats, what programs you're using to calculate your T12 and rent roll, it's just hard to standardize that. And that's the main issue we run into. And that's the big problem that fintech is running into, because everyone has their own process. So you have to think of a standardized way.
Excellent. Yeah. And to those investors out there that are looking for something like this, you can also just do a Google search on underwriting tools. Michael Blank has one, Dave Lindahl and Ari Mentor, they have one, very simple spreadsheets, Excel version that you can just plug numbers in and play with them to see if it makes sense for you. So there are some out there that you can find that way. And I'd recommend that if you are looking to invest at this time, which is, as we discussed, potentially a great time to invest because there are deals out there. You can underwrite them yourself and make sure that it makes sense for you. Actually, going back to that opportunity question, what I am seeing also are loan assumptions that are happening. A lot of those are happening where people have fixed rate debt, low interest rate. It's a very low LTV, but it's pretty much the same as they could get if they got new debt. And I'm seeing a lot of those transactions happen. In fact, we have one that we're working on right now. We're hoping to close very soon. And it makes a lot of sense to pursue this type of asset.
Yeah. To your point, I think that's something that's been making the few deals that are transacting right now. I would bet their loan assumptions just because, like, to your point, you look at a 55% LTV, but the rate say 4.5, right? And if you go to get a new loan today, you're still at that same loan to value, but maybe a point or two higher. And that's why assumptions have been tremendous right now. Well, a lot of loans, as mentioned again, looking at it from a HUD lens, a lot of the projects that we closed loans on essentially during early 2020, 21 to 22 are being sold right now because they have a 2 handle on the interest rate. And despite the fact that they're lower LTV, they're beating the market because the LTV is essentially the same, but the rate is a point or two lower. So you nailed it.
Yeah, absolutely. Okay. And I'm going to ask you another question. We've discussed a little bit about this, but just to maybe you can add some more flavor to it. What trends and developments do you anticipate in the multifamily real estate market as a whole over the next year or two? And how is Dwight Capital positioning itself to take advantage of these trends?
That's a good question. So the trends I think we're going to see is more sophisticated developers and sponsors and purchasers of project are going to be ones that dominate the market, right? So one of the pros, if you want to look at it from a silver lining to this downside, the sophisticated investors that have planned properly, the ones that'll survive this will come out on their side stronger. And so more or less for us and overall market is aligning ourselves with those sponsors that have planned appropriately because we service all of our loans. As I mentioned, we don't want to foreclose or anything of that nature. So aligning ourselves with good sponsors by and far the number one priority for us internally, because then there's that level of trust. There's a good working reputation, rapport, all those things up front. So aligning ourselves with good sponsors by and far number one priority. Surviving this downturn, survive. There's a phrase that's being coined on like real estate social media. It says 5 to 25. That is something that's been trending, I guess. And I'm more aligned with that and finding good partners to survive with.
Yeah, I like that. Survive till 25. It makes sense. It rhymes. Sounds
It's
good.
catchy.
Yeah,
Exactly.
absolutely is catchy. Let's finish up with some advice from you. What if you have investors looking to enter the multifamily real estate market? How would they start in this type of market? Maybe talk about financing their projects. How would they start looking at financing, that type of thing?
Sure. So if you're looking at investors, if you're looking at it more of a passive investor, so we'll break it down 2 buckets. If you're looking at investors, I said it before in my last answer, but finding good sponsors to work with, folks that are seen a few things, been around the block, know what they're doing and are coming out of this. That is by and far your number one way. Track record is going to be, that phrase, past results are not indicative of future ones or something of those lines. That more or less will hold here. In terms of sponsors, to your point about those models, fact check everything, look at it for yourself. You can align yourself with good sponsors, but it doesn't hurt to give yourself this peace of mind to make sure, look, all their assumptions are reasonable and there's nothing that they're going out on a limb on. They're not expecting a 15, 20% rent growth year over year in a market that has seen historically 5 to 10%. Those are the things that I would recommend. And just being cautious in the sense that the deals will come again. I'm a firm believer of that. You don't need to say, hey, I need to invest just for the sake of investing. You want to pick your spots. So that patience and finding a good sponsor to be patient with, good lead sponsor to be patient with is my biggest advice.
Excellent. Good advice. We really focused on the multifamily asset class because we're both very specialized in that class. But what about other asset classes? Industrial, hospitality, any thoughts on different classes and how they're faring currently compared to multifamily?
We're starting to see hospitality come back pretty strong. Industrial has not wavered, ironically, but weirdly in my mind. Industrial has been consistent. It's been positive more or less the entire way through, especially in the post-COVID, if you want to call it that. That has been by and far my biggest surprise. Retail is still struggling. We're starting to see a lot of conversions from retail and office into multifamily. That was a big idea and also hotels, people weren't as successful with it on hotels, just because the hotel market, hospitality market came back pretty well. But we're starting to see more office conversions throughout the country. It's something that we're trying to get a handle on, and the idea sounds great. It's just not as feasible because of the floor plates, the utilities maintenance, the scope. You might just knock the thing down and rebuild it at that point.
Yeah.
A lot of being in New York, that was very much in vogue with work from home. And you probably see 1 out of every 30, 40 projects actually go through with that. But office in New York, you're starting to see the occupancy rates tick up slowly but surely as the pushes come out. You're seeing sort of the leaders of New York and nationwide start to speak up about the impact of being in the office. And I think office will rebound just because I have younger siblings and I'm starting to see them, what work from home does. And
right. Yeah. The main thing is you can dress up on the top and bottoms, anything goes.
Exactly. You don't.
Yeah, that only leads to badness.
Yeah.
Brandon, this was amazing. Before we end, anything else you want to add? Any other pieces of advice or anything you can think of that you want to share with our listeners?
I think overall is just being aware. As more and more I learned it, right? Being a real estate guy, I've learned more to follow the other things. Everything is cyclical. Everything is intertwined. And so seeing or CPI doesn't necessarily, you wouldn't think, but you and I have acknowledged that it does impact us and how that impacts inflation, to how that impacts rates. So getting a holistic understanding of what's going on in the world and where those drivers are. And then specifically into the real estate and multifamily market, the market fundamentals. I mentioned that earlier, but one of the things we saw a lot of the big headlines in all the major papers was that people were leaving big cities and going to these suburbs. And that was true. The question is, what is the staying power of those suburbs? And we're starting to see a lot of those suburbs start to fall back to what their pre-COVID days were in terms of, and they're not absorbing, their vacancy rates are ticking up. So those are the things, the fundamentals, and then that's what I saw.
Great. Excellent advice. You really were able to deliver a bunch of useful information in that short period of time. So absolutely appreciate it. And we'd love to have you back at some point.
Appreciate it. Thank you for having me.